Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at critical metals.
If you find our talks useful, please consider subscribe, like, and comment underneath. So I want you to imagine for a second that you're looking to buy this massive, sprawling 1,000-acre estate.
Okay, sounds nice.
Right. You hire a professional appraiser, they come back, and they tell you the property is worth $3 billion US.
Wow.
But then, you read the fine print of their report, and you realize they only looked at the guest house.
Oh, wow. Just the guest house.
Just the guest house. They completely ignored the main mansion, the timber, the farmland, all of it. And today, we are looking at a development stage mining company in exactly that situation. They're sitting on a physical asset valued at $3 billion based on extracting just 1% of the rock they actually have access to.
It is, honestly, a staggering setup. And the market reaction is just as extreme, right? The stock is experiencing these wild bouts of volatility.
It's totally bipolar.
Exactly.
Yeah.
If you look at the analyst community, there is zero consensus. You have major voices screaming that this is like a generational buy, while others are issuing these really stern warnings to just stay far away.
And that extreme disconnect is kind of our mission for today. We need to figure out what is actually happening beneath the surface here.
Right.
So we're going to unpack the massive geopolitical moat surrounding critical metals. We'll weigh their recent operational breakthroughs against the very real financial distress signals that are kind of flashing in the background.
Because there are definitely some red flags there.
For sure.
Yeah.
And ultimately, we are going to map out the 12 to 24-month investment horizon to help you decide if the asymmetric upside here is, actually worth the risk.
Yeah, because whenever you see a valuation gap this wide, something has to give.
Yeah.
I mean, the market is either fundamentally mispricing a world-class asset, or there are execution risks so severe that a $3 billion valuation is just, well, it's nothing more than a fantasy on paper.
Right. And you really can't understand the wild swings in the stock price without first understanding the mountain that's driving all this math.
The literal mountain.
The literal mountain, yes. The primary asset is the Tanbreez Rare Earth Project, which is located in southern Greenland. And when we talk about the scale of this deposit, the numbers are almost difficult to process. We are talking about 4.7 billion metric tons of mineralized rock.
Which is just insane. It ranks as one of the largest rare earth deposits on the planet. And to put a financial framework around that much rock, an independent preliminary economic assessment, a PEA, was published in March 2025.
Okay, and what did that say?
So that assessment calculated a net present value of approximately $3 billion US for the project.
$3 billion?
Yeah, and it also projected an internal rate of return, or IRR, of roughly 180%.
Okay, wait, let's pause on that 180% IRR for a second. Because in the mining sector, an IRR above 30% is usually considered fantastic.
Oh, absolutely. A home run.
Right, so a 180% return implies the project basically pays for its initial capital expenditure almost immediately once it's fully operational.
Exactly.
But I want to go back to that opening analogy, because that $3 billion valuation and that 180% return, those are based on a mine plan that only targets 1% of the project's host rock.
Just scratching the surface.
Literally scratching the surface. But it's not just the sheer volume of rock, right? Because we hear the term rare earths thrown around constantly in the news, but Tanbreez is specifically focused on heavy rare earths. Why is that distinction, so critical for you as an investor right now?
Yeah, so the distinction between light and heavy rare earths is the entire foundation of their competitive moat.
Okay.
Light rare earths are generally more abundant, they're slightly easier to process, and a lot of critical metals peers focus right there. But heavy rare earths are chemically different.
Harder to get to.
Much harder. They're much scarcer, they're usually found in lower concentrations, and their chemical bonds make them notoriously difficult to extract.
Right.
But here's the catch. They are entirely non-negotiable for modern technology.
Yeah.
I mean, you cannot build advanced defense systems, high-performance permanent magnets for EVs, or next-gen renewable energy tech without them.
So you have to have them.
You have to. And additionally, this specific rock contains strategic byproducts like gallium and hafnium.
Which are used for what, exactly?
Well, gallium is critical for semiconductors, and hafnium is heavily used in nuclear control rods and aerospace alloys.
Okay, so the asset is incredibly valuable purely from a chemical standpoint. But the fact that this mountain is sitting in southern Greenland isn't just a geographical footnote, right? It feels like the main selling point.
Oh, the location is a massive strategic lever.
Yeah.
Because if you look at the global supply chain for processing and refining heavy rare earths, it is overwhelmingly dominated by China.
Right, which is a huge geopolitical issue right now.
Exactly. So by developing a multi-generational asset in Greenland, which is a highly stable, Western-aligned jurisdiction, Critical Metals is offering a direct geopolitical hedge.
Makes
It plays perfectly into current U.S. and European mandates to, secure independent supply chains and decouple from potentially adversarial nations.
right, getting away from that reliance.
Yeah. And to solidify this advantage, the company actually just recently acquired a majority stake in 60 Degrees North Greenland.
Oh, nice.
Yeah, that move basically consolidates their operational control over the region and really streamlines their ability to develop the infrastructure there.
Right. Okay, so having billions of tons of vital, geopolitically secure rock under the ice is a great story. But having the rock doesn't pay the bills.
Not at all.
Actually, ripping those materials out of the ground and doing it in a way that turns a profit is this massive engineering hurdle. Which brings us to their recent operational breakthrough, because the underlying math of this entire project just shifted dramatically.
It really did. Mining at this level is essentially a giant, highly complex chemical engineering challenge. You have to separate the valuable elements from the worthless dirt. And recent metallurgical testing showed that Critical Metals has drastically improved that process. They successfully replicated historical lab results, and more importantly, they improved their refined concentrate production by 40%.
Wait, 40%. Let's make sure the gravity of that number lands for a second. A 40% improvement isn't just a minor optimization.
No, it's huge.
If we think about traditional chemical extraction, it's kind of like taking a fully baked cake and trying to unbake it to get the flour and the eggs back out.
That's a great way to put it.
Right. It is incredibly difficult and super wasteful. So if you suddenly find a new chemical recipe that lets you pull out 40% more of the valuable ingredients from the exact same slice of cake, your unit economics just completely transform.
Exactly. And looking at the specific data from their 2025 test work, the new process yielded a concentrate containing 2.96% total rare earth oxides and heavy rare earth oxides.
Okay, and what was it before?
Back in 2016, they were only achieving 2.1%.
Oh, wow. So that is a huge jump.
Huge. Every ton of dirt they process now yields significantly more sellable product. Furthermore, their recovery rates, which is the actual percentage of the targeted mineral they successfully pull out of the raw ore, exceeded 85%.
That's incredible.
Yeah, that means less waste, lower relative processing costs per ounce, and much, much higher margins.
Okay, so getting more of the good stuff out while leaving less in the tailings pile is obviously fantastic. But I feel like this creates a really interesting paradox for investors.
How so?
Well, because this efficiency jump is so massive, management announced that the $3 billion preliminary economic assessment from March 2025 is now completely obsolete. They have to replace it.
Right, they threw it out.
Yeah. And I have to push back on how the market digests this, because on one hand, the old report is obsolete because the new methods are vastly superior, which implies the future valuation will be much higher.
Yeah.
But on the other hand, doesn't that mean investors are completely flying blind right now? I mean, if the foundational financial document is thrown out, isn't the market just guessing at the intrinsic value?
I mean, it does create an information vacuum, for sure. And markets inherently despise a vacuum.
Exactly.
So yes, investors are flying blind regarding the exact decimal points of the new net present value. But in the resource sector, making your economic assessment obsolete because your metallurgical recovery just spiked by 40% is like the best possible reason to lose your baseline.
Fair point. It's a good problem to have.
Exactly. It signals that whenever the updated assessment is published, the projected cash flows should be significantly stronger, or the capital expenditures required to hit those cash flows will be lower. So the uncertainty drives volatility, yeah, but the underlying catalyst is deeply positive.
Well, since you brought up capital expenditures, we really need to talk about the money. Because perfecting these chemical extraction techniques in a lab is one thing. Building a commercial scale mine and processing facility in Greenland costs an absolute fortune. Right. And Critical Metals is a development stage company. They are pre-revenue. They aren't selling commercial product yet. So how on earth do they fund a multi-billion-dollar vision without just going bankrupt?
The financing strategy is the most critical variable for a pre-revenue miner. In January 2026, Critical Metals executed a term sheet for a 50-50 joint venture with a leading Saudi Arabian industrial conglomerate.
Okay, that's interesting.
Yeah, and the proposed scale is massive. We're talking up to 1.5 billion US dollars to construct a dedicated rare earth processing facility.
Man, a $1.5 billion injection would completely transform the company.
Overnight.
And they seem to be operating with a new sense of urgency since that announcement, right? Because in March 2026, management approved a $30 million acceleration program designed specifically to fast-track the development of the Tanbreez project.
Yeah, they're stepping on the gas.
Plus, they are acquiring a proof-of-concept pilot plant for about $2 million, which is slated for commissioning in the second quarter of 2026.
And that pilot plant is a crucial step in capital preservation. Because, before you spend $1.5 billion building a massive commercial-scale processing factory, you build a miniature version of it.
Right, you test it out.
Exactly. The $2 million pilot plant allows them to run their newly optimized, highly efficient metallurgical process continuously at a smaller scale. It basically proves the lab math works in the real world, which heavily de-risks the final engineering plans for the massive Saudi-backed facility.
Okay, but I need to play devil's advocate here regarding that Saudi deal because the wording really matters.
Sure.
A $1.5 billion deal sounds like the ultimate de-risking event, but a term sheet is, by definition, non-binding. It is an agreement to agree in the future. It is not cold, hard cash sitting in Critical Metals' checking account right now.
That's true.
So how much weight should you, as an investor, actually assign to a non-finalized piece of paper?
That's the billion-dollar question. The probability weighting on a term sheet depends entirely on the counterparty. A term sheet can absolutely fall apart during final due diligence.
Right, happens all the time.
It does. However, in heavy industrials, securing a term sheet with a major Saudi conglomerate carries immense signaling power. Saudi Arabia is aggressively pushing industrial diversification away from oil, and these conglomerates employ world-class technical teams to vet projects.
So they aren't just signing things on a whim.
No, they do not sign term sheets lightly.
Nothing.
So while it isn't finalized capital, it represents intense third-party institutional validation of the Tanbreez asset's underlying value and that new metallurgical process.
Okay, so let's look at the scoreboard here. We have a 4.7 billion ton world-class asset.
Yep.
We have a massive geopolitical moat. We have a 40% leap in processing efficiency. And we have a potential $1.5 billion partner. On paper, this sounds like an absolute slam dunk.
It really does.
Which makes the current reality of the stock so jarring. Like, why is there so much negative sentiment out there? Let's dig into the bear case because the distress signals are flashing bright red.
They are. The execution risk is where this whole narrative fractures. The analyst community is deeply divided on Critical Metals' ability to actually get this project across the finish line.
Yeah, I saw that Freedom Capital recently upgraded the stock to a strong buy, citing the asset value.
Right, but then Weiss Ratings reaffirmed a sell rating.
And it escalated on March 19th. Seeking Alpha issued a major downgrade, dropping the stock to a hold. And their reasoning didn't mince words. They explicitly cited ongoing financial distress and a significant production delay.
Yeah, those are heavy words.
I find this incredibly confusing. I mean, how can management announce a $30 million acceleration program in the exact same month that major analysts downgrade them for significant production delays and financial distress? Which reality are we supposed to believe?
The crazy part is both realities are coexisting right now, which is a classic hallmark of a development stage miner.
Wait, how does that work?
Well, a project can be delayed relative to its original overly optimistic multi-year timeline, which totally justifies the analyst downgrade.
Okay, sure.
But simultaneously, management can secure new interim funding to try and accelerate their revised delayed timeline.
I see it.
But the specific label of financial distress usually points directly to the mechanics of how a pre-revenue company is keeping the lights on. It points to the capital structure.
And that leads us straight into the share overhang risk, because this is vital to understand if you are looking at the stock price. The company recently filed a prospectus for the resale of over 2.7 million shares.
Yeah, that's a lot of shares.
It is. These shares were originally issued to private investors during a previous private placement. But the crucial detail here, the part you cannot ignore, is that Critical Metals receives absolutely zero proceeds from this specific resale.
None. And when those 2.7 million shares hit the open market, it creates massive sustained selling pressure. The existing private investors are cashing out their positions.
Right.
And the company itself doesn't get a single dime of that liquidity to build their pilot plant or fund their acceleration program. It simply dilutes the trading pool and suppresses the stock price.
Think about it like trying to sell your car. You might have a great car, well-maintained, worth a solid price. But if you park it in a lot to sell it, and suddenly 3 other people show up desperate to sell the exact same model for cheap, the value of your car plummets.
Exactly. Supply and demand.
The sudden flood of supply tanks the price, regardless of the underlying quality. So you have this intense tug-of-war happening, incredible long-term asset value trying to pull the stock up, while immediate-term dilution and execution delays drag it right back down.
And that tug-of-war is directly responsible for the bipolar price action we are seeing on the charts.
Let's look at a prime example of that whiplash, because on March 31st, the stock surged 8.4%, hitting a high of $7.23. At first glance, that looks like a massive breakout, directly fueled by the news of those 40% metallurgical improvements we discussed.
It does look like that, but digging under the hood of that rally reveals a massive structural weakness.
The volume, right?
Yes, the trading volume on that 8.4% surge was dangerously low. Only about 789,000 shares changed hands during the session.
Which is nothing for them.
Right, to contextualize that, Critical Metals' average session volume is over 16 million shares. The volume during this supposedly massive breakout was down 95% from the norm.
Volume is the truth teller in the market. I mean, an 8.4% price jump on a 95% drop in volume is like throwing a massive, lavish party to celebrate your new metallurgical test results, only to realize that 95% of your invited guests decided to stay home.
That is exactly what it is.
Right. A few retail traders might be partying in the living room and pushing the price around, but the smart money, the major institutional buyers who traded millions of shares, they simply weren't participating in that rally.
No, they were sitting it out. In technical analysis, price action needs volume to confirm the strength of a trend. A breakout on anemic volume is highly suspect and very prone to collapsing back to its baseline.
Yeah, that makes sense.
But we also need to realize that the price action isn't just driven by company-specific news. We have to widen the lens here, because the stock is highly sensitive to macroeconomic drivers.
Oh, absolutely. It is practically acting like a leveraged proxy for global growth right now. I mean, even if they solve the engineering and secure the funding, they are still at the mercy of the broader economy.
Exactly. The historical data shows the stock consistently trades higher on easing energy prices and a weaker U.S. dollar. It also catches a strong bid on the expectation of potential interest rate cuts.
Right, like that recent bump we saw.
Yeah, recently the broader industrial materials sector caught a massive tailwind, spurred by a social media post from President Trump regarding lower rates. When capital is cheaper to borrow and global growth projections look promising, industrial commodities just thrive.
But on the flip side, the stock trades sharply lower on fears of Middle East conflict.
Right, because of the oil connection.
Exactly. The energy connection there is huge. If conflict spikes global oil prices, the cost of moving billions of tons of dirt and running massive chemical processing facilities just skyrockets. So as an investor in critical metals, you aren't just betting on their ability to pull hafnium and heavy rare earths out of the Greenland ice.
No, you're betting on a lot more.
You are inadvertently placing a bet on global energy markets, currency fluctuations, and macro interest rate policies.
The macro environment acts as this massive headwind or tailwind that operates completely independently of the Tanbreez Project's actual geology.
Okay, so bringing all of these complex threads together, what is the clear, actionable thesis here? If you are looking at the next 12 to 24 months, balancing the $3 billion potential against the dilution, the delays, and the macro sensitivity, what is the final verdict?
Well, distilling all these factors, the final investment thesis gives Critical Metals a bullish score of 7 out of 10.
A 7 out of 10.
Yes. The classification is a speculative long-term hold, specifically scoped for a 12 to 24-month horizon.
Okay, so speculative is the key word there.
Highly speculative. This is absolutely not a stock for risk-averse portfolios. It is designed for investors looking for a blue-sky entry point. The strategy basically relies on buying in during a period of current weakness and immediate financial distress, betting that the underlying asset value will eventually be realized once the processing facility is funded and operational.
Got it. And if you are taking that risk and committing to that 12 to 24-month horizon, there are really 2 distinct catalysts you need to watch.
Yep.
First, the Q2 2026 commissioning of the $2 million pilot plant. If they get that plant running smoothly and prove that the 40% efficiency boost works continuously at scale, the engineering risk plummets.
That's a huge milestone.
And second, the release of the newly updated preliminary economic assessment. When management finally puts fresh financial projections to that massive deposit based on the new metallurgy, the information vacuum closes and the market will finally have a solid new baseline to trade on.
Because everything ultimately comes down to execution. I mean, the rock is there, the chemistry works in the lab. The question is whether management can bridge the gap between their current diluted financial reality and the incredible wealth buried in Greenland.
It is honestly one of the most fascinating risk-reward setups in the sector. But before we wrap up today's analysis, we want to leave you with one final provocative thought to consider as you weigh this thesis.
Yeah, so we established earlier that a massive portion of this project's viability and the premium the market might place on it hinges heavily on Western independence from Chinese rare earth supply chains.
Right.
So consider this. How might a single, unexpected shift in global trade policies over the next 24 months instantly alter the landscape?
Oh, that's interesting.
What if there's a sudden thawing of diplomatic relations or a new bilateral trade agreement that floods the market with cheap, heavy rare earths? Could a simple stroke of a pen in a policy room make or break this entire $3 billion thesis?
It is a stark reminder that sometimes the biggest risks to a mining project aren't buried deep in the ground. They are drafted in capital cities half a world away. We'll leave you to ponder that one.